Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Geez, I get fired up every time I hear that intro music. It reminds me of where I am. And the very important work that we're doing here, navigating property investment in Australia for investors, by investors, for investors. It says it on the tin, what we're up to. This is the Smart Property Investment Show, the final instalment of our special series around the Fast 50 report. Welcome. Wherever you're tuning into this, you're in your car, riding on your lawnmower, if you're walking your dog, if you're at the gym, whatever you're doing, however you're doing it, choosing to tune into this podcast to increase your knowledge, understanding, appreciation and strategy as you invest in property. Welcome and get a real kick out of doing this. And also if you're watching us on the interweb, wherever you're tuning into us, welcome. How are you going? I have, and I'm going to show it here. I keep it lean here over at Smart Property Investment. It's black and white. I don't use colour ink because this is the Fast 50 report. Where to put your money today for the best returns in 2024. The top suburbs, the top investment suburbs for 2024. It's been in the market now for about a month or so. Huge amount of questions have been coming in, and we thought we'd answer them because it's posed more questions than what we tried to solve by putting a report together with our friends over at Pure Property Investment, joining me in the studio to try and navigate some of these questions because I don't know what I'm talking about. He sort of does. Paul Glossop, he's the CEO over there. How you going?
Very well, sir, and thank you for having me. I note that you probably don't use colour ink because it brings out the wrinkles as much in your mugshot on that second page you got there.
You know what? Like, for a bloke who spent his life in the sun, I'm not doing too bad, to be fair.
You're kidding yourself, aren't you? You've been in an office for more years than you haven't been.
Hence the reason why I have such a good exterior. The Juco's still in good nick over at Smart Property Investment.
Needs a heavy buff.
The Juco is still in good. The engine less so. Might need to bore it out 30 foul, lower it a bit, we'll be all right. But much like the property markets, you're always trying to finesse and tune it, Paul. And I do note also for our friends tuning in on the video, I also have all of our other expert panels. Most of them you know. Some of these you actually sit on the board of PIPA with the Property Investment Professional Australia.
Nicola McDougall, who's our chair.
Yes.
Steve Waters.
He's there, Director of Right Property Group.
Yeah, correct. I don't know if there's any other board members on there at this stage anymore. Margaret Lomas was an ex-board member, also ex-chair.
Yes, that's correct.
Yep.
The who's who of the zoo. You're there. Paul Glossop, CEO of Pure Property and Garrison. Matthew Lewison, CEO of Open Corp. The chief economist from PRD Real Estate, who was really, really good support with this particular report. But I sort of balked a little bit on saying a name because I'm probably going to make a meal of it, and I do apologise in advance. Dr. Diaswati Mardi Samo.
Fluency was.
I'm so sorry. I do apologise, Doctor, if I get the wrong. It's one of those things. Like I'm not bad at talking, but like with names and stuff, I just butcher them, and I'm really conscious that it's rude. So I do apologise, Doctor. But you'll have to come on and have a chat with us at some point in time. But I do a lot of like for a lot of our awards, like giving away the finalists are, and this is the winner. And sometimes on a Friday night, trying to get some of those out. Yeah, I just say it really fast. Kevin Brogan's there, National Director of Group Risk Compliance at Heron Todd White. You mentioned Nicola. John McGrath, CEO and Executive Director of McGrath, one of the best names in real estate. Arjun Paliwell, good buyer's agent. Founder, Head of Research Investor-Kit. Charlotte Pascoe, CEO of Stockdale and Lego. Good outfit, good real estate firm. You mentioned Margaret. Simon Presley, Head of Research Propertyology, another good buyer's agent. Angus Rain, Executive Chairman, Rain and Horn. You mentioned Steve Waters and Lena Lindy. She's in your team.
She is.
Senior buyer's agent, Pure Property. How's she getting on?
She's literally on site as we speak. I just got a text from her.
What's she looking at? Tell us. Give us a skinny.
I know today she's doing a final inspection of a property that I've recently bought for my super fund, and in among that, I think there's about 25 other off-market properties she's going through in the next 3 days. I'll give us a city of Perth she's in for the next few days.
Is she out there, is she?
She's there as we speak.
All right.
Yeah, and that's part of that.
So
on
you're
the ground
buying
part.
something in your super fund out in Perth?
I am buying a couple of things in my super fund out in Perth personally.
Residential, commercial?
Residential. I'll go through the full skinny of it.
Tell us.
It's a So there's two properties, one of which I'm about to put under contract in Armidale, and the other one I'm about to put on, or have got under contract and will soon settle in Mandurah, a little bit south Perth on the coast
So
there.
two properties. Have you got properties in
freestanding-
your super fund yet?
I do.
Yeah,
I do. These are to add to that portfolio. But Perth, as per the Fast 50 guide, it features quite heavily. And I personally see a lot of value in that market. I need to get some exposure in there for my resi side. The property in Mandurah specifically, it's about a 1,200 square metre, bit of an older property, quite an interesting one. It's the property that a couple of my clients didn't want to buy, and I looked at it thinking I can't pass that up, and I bought it. 1,200 square metre, as I was saying, R100, which is the equivalent of R4 zoning if you're in the New South Wales money, essentially unit block zoning, massive block of land, couple of blocks from the beach, 370 grand, $420 a week rent, 3-bedroom, fibro house. Not exactly the prettiest house, but habitable,
Just
rentable, tenant in
there.
place already. It's too hard to pass those things up in a market that's grown 10% in the last 12 months and has got a huge amount of upside.
What sort of financing are you doing? Like 70% on it, or
80% LVR
okay.
through the team at Finney. They found I think we probably got it was about a 6.6%
It's not bad.
yield. Interest rate on that.
Who with?
It's with Macquarie.
Macquarie.
Yeah.
So they're back doing a lot of
SMSF stuff.
SMSF
Yeah,
because a lot of people left for a long time.
they did.
And prices got really heavy. But that's pretty sharp at six and a bit.
Yeah, I mean, it might have. I
probably gone up.
signed docs a few weeks ago. That might have been pre the most recent rise. But even if I'm factoring 20% cash in, which typically that's going to be minimum for an SMSF, that property
Will it cost you anything to hold?
very little, very little.
Okay. And you're still doing your contributions
Exactly,
anyway.
I'm contributing anyway. So I've got two properties. The Armidale property, again, Perth, very similar. It's about a 410k purchase. That's more of a set and forget, 4-bed, 2-bath, 2-car garage, 600 square metre, about a 20-year-old, again, off market. So probably got that, I'd say, a good 25k below what it should be selling for. But again, that was renting at about $480 a week, about a 6% return, nothing to contribute. And for me, these are the ones that I'm plonking in the SMSF portfolio, pretty comfortable.
Yeah. How much you want your SMSF?
How much do I want in there?
Yeah.
I think for the next 5 years,
Enough.
I'm going to go as heavy as I can, to be honest with you. I mean, realistically, I'd probably plough it out to, I've got probably another 15 to 18 years before I'd perceive to be retirement or pension phase after that. So I'm probably trying to get it up to sort of that 3 to 5 million mark pretty comfortably in that next
In the
5
super
years.
fund?
In the super fund, as far as assets, value of assets, and then give them the best chance I can to switch them to P&I and aggressively pay down as much as possible, and probably look at selling a small portion at the back end, ideally, is the plan with that.
There you go. So Armidale was in a report. Number of properties sold, 442. You said Armidale. didn't you?
Armidale, correct? Yep.
442 sold, meaning quarterly growth, 1.7%. Annual average growth, 1.8%.
Yeah, over the last 10 years.
Yep.
Yeah, correct.
Yeah, that's
Yep.
correct. And one of the questions around methodology, we'll get into that. 12-month growth, 10.9%.
Yep.
Gross rental yield, 6.5%. Median rent, 380. Median price, 305. What are you paying there?
I paid over 400.
So you're at the top end.
Yeah,
of
absolutely.
That.
And
yeah.
this sort of me probably points me out more that I'm buying a quality asset in that market. So as I was saying, it's more of a modern property. The property literally has been owned by a GP who used the property as a fly-in, fly-out base, and the property is a relic. It's about 18 years old, hasn't been used. The property literally is warranties in place, dishwasher, it's still got stickers on it and shows it actually hasn't been used. This is one of those classic properties which it's perfect.
So you just leave it.
Yeah, leave it.
All right, Mandurah, part of Perth, 6210. Let's have a look here. Yes, Mandurah is a thriving coast city, vibrant lifestyle, stunning beaches, bustling dining, and to name it, scene. Beautiful waterways, abundant wildlife, Paul, and extensive recreational activities. It's a destination for families, retirees, and sports enthusiasts alike. 28 kilometres from Rockingham, 72 kilometres from Perth. So it's like the central coast of
Pretty much.
Perth.
Yeah, pretty much.
Yeah.
You're getting the equivalent.
108
amenities.
kilometres from Bunbury. There you go. Cool.
Yep.
268 sold. That's annual when these numbers were. 2.9% quarterly growth. 2.3% average annual growth. 12-month growth, 12.9. So these are why these things made the list, right? They've
Correct.
done nothing
No.
in 10 years.
And value is extreme. when you look at.
So it's pretty much you're buying it for what people paid for them 10 years ago.
Correct.
Yeah.
And you're getting, in a lot of these cases, particularly in Perth right now, you're buying quite a number of assets in some of these areas below replacement value. So if you were to replace the actual dwelling, take out the price of the land, that's what you're buying these assets for. You can't build a brand new property for really sub 400 grand for a 3 or 4 bed, 2 bath, 2 car garage freestanding house anymore.
What, just a brick house?
Yeah. Low spec off the plan. If you're going to see anyone's final numbers with some fences and basic landscaping, 350 to 400 grand would be
to get
absolute bottom of the barrel.
Yeah.
Yeah.
Okay.
So you start to do your math. You're like, well, if you're buying a house for that example of Armidale, touch over 400 grand on a 600 square metre block where blocks are still selling for about 150-ish grand, you're effectively getting the house for free, the land for free.
And this goes to the point, and we'll touch on some of these questions, but people talking about the potential for Australian property markets to drop by 40%. If it costs that much just to build a house, not alone getting the land, you've got to get a sense for why and how properties will decrease by 40% on the basis that people want to buy it, and you've got a huge influx of migration, and no one's building more houses.
Yep.
So,
and that's not going to change for a pretty prolonged period of time, unfortunately, because even if we wanted to, there's so many different headwinds that are going to affect that for a long period of time.
And you only need to look, I spent last week in Canberra, and the government who come in May of last year, and this is not a political podcast, I'm just making some observations. They've had a long honeymoon period, and I think there's my take of it all, and chatting with people down there, there's this realisation that the honeymoon is certainly over, and now they're not new to government. They've been in now for over a year, and the rubber now starts hitting the road, and that's what they're saying. The government's saying is going, look, we come into it, and we've done pretty well, and we sorted some stuff out, but now we've got to start doing something. We've got to start being in government. And I reckon this government will probably get at least 2 terms, is what I'm saying. You might even get 3 terms. You might have a three-term Labor government. So expect the next decade to be under the steward of the Labor government. Rightfully or wrongly, it's absolutely irrelevant. I think that's just the way it's going to be. So they've got to start doing stuff. And to your point, to mobilise the building sector to accelerate the rapid building of dwellings is going to take a lot. And that's just not regulation and bureaucracy and policy setting and everything. It's highly connected, intrinsically connected with the health of the economy right now. Look, there's 2,000 builders have gone bust the last financial year, right? There's not as many around. So,
and then you start to lump in what you've just mentioned. We've just seen that $10 billion future fund's been voted down in the Senate. So that's technically doesn't look like that's going to happen.
But $10 billion ain't going to get you far anywhere.
They're talking about a commitment to building 1 million new properties in the next decade. But, go and tell me how that's going to happen. You've got the Greens against it. You've got the Greens trying to discuss rent freezes. The Libs and Nats they're not supporting any of it. So you're just not going to get anything but headwind there. So when it comes down to it, it's going to come down to private enterprise.
Yeah.
And if private enterprise can't access funding, and we've got no changes to zoning or no easier access to streamlined DA approvals, etc., where's it going to change? I'm developing property personally every single quarter as we speak for the next 3 years, and I've got personally a bit in pipelines right now. And I've got property in far north New South Wales where we just went through, ironically, a development that I had underway. Here's a funny story for you, Phil. I don't want to divert too much. The Lismore Council, we put a DA in for 22 houses to be developed in the broader Lismore area, unflood affected, and obviously they've got a very, very big housing shortage still to this day, a year and a half after their devastating floods. They chose to promote the DA that we put in there. They leaked it to the Daily Telegraph, and it was on page 10, I believe, the Daily Telegraph. About 2 or 3 weeks ago, rather. Not telling us that they've leaked it, but talking about the fact that they're going to support developers to build some flood-free new development that's coming out of the ground. That came out, but we had no correspondence. Basically, it's just free PR for them to say we're flying the flag for new development. They're not fast-tracking our development. We're going through the same rigmarole. We don't expect that.
If I was you, I'd be calling up the local council now. Here's a hot tip.
I tried, Phil. Here's the irony. I tried to contact the local mayor of Lismore Council. I tried to email him and tried to essentially explain what we're trying to do here. Nothing's going to change. It's going to go through the same red tape, same process. We won't get approval for 12 months. Then we'll go through the next level of construction certificate, etc. Nothing changes.
And then they'll find a frog.
Exactly.
An endangered frog.
And then we'll delay, and then we'll have to get an environmental report. And we're doing everything by the book because, ironically, we've got some koala ecology aspects that we have to consider and all those types of things, which we've gone through.
Koalas are endangered.
Absolutely. And hence why we've had to go through some pretty rigorous – and we have. We've kept a whole bunch of trees. And I mean, I don't want to get too deep in it, but my point with this is that it doesn't matter what we're trying to achieve or what anyone's trying to achieve here. Government aren't going to do the bulk of the heavy lifting. 96% of investment properties in Australia are bought and provided by private
Everything
enterprise.
gets politicised. And to your point, the government and the trappings of government, whether it's local government, state government, or federal government, what they need to do is work out what levers can they pull and what buttons they can press to move as fast as possible. And historically, you put it into the hands of private industry. Is what you do. You have to do it. But what you're doing, you're still getting stifled, right? So they've got to work out how they can get mum and dad property investors and mum and dad owner occupiers to build their properties.
Yep.
That's where the stimulus should be going. That's where the focus should be going. And I'll tell you how many people I spoke to last week down in Canberra around, everyone's sort of whispering in the shadows going, I reckon they're going to get rid of negative gearing. I reckon they're going to get rid of negative gearing. Mate, you want to put the handbrake on Australian property?
Could you imagine?
You want to put the handbrake on and stop it completely?
You want to see a rental issue.
There you go. And I don't think they will do. I reckon they know that. The governments, they had a crack at it and they got burned. I think they'll be folly to do that. Yeah. Absolute folly. That's how you stifle everything. But just while you're talking about state governments, local governments, I've got a place, you know this property. It's in the western suburbs of Sydney. You'd know it pretty well, right? Get this note from council, the other Blacktown Council. I'll name him and shame him. Blacktown Council pretty much saying, after all the floods of the last 5 years, we've decided that the property that you have now is now within a water affected area. And all they've done, the street, they've redrawn the map. They've got some fancy consultants in, right? Probably paid them $1 squillion to do it. And they've redrawn the lines, so now the water, their little map thing comes up and into this property, covers half of the property.
So 1 in a 100-year event now ingresses on your land.
Absolutely,
which changes the zoning.
Which changes everything. It means that now I've got to have I sent them a note. They're saying yes, we're doing a consult. Blacktown Council, 250,000 people listen to this podcast, and I'm going to name and shame you. I sent you a note and you haven't responded. Right, as an investor and someone that pays my rates,
there'd be no shortage of investors who have property in Blacktown City Council who listen to this podcast. Yep. Question for you, Phil, on that: how much water went through that property?
Zero. I know of this property. I know this has been connected with this property for 60 years. Right,
my goodness,
never flooded.
And you grew up in that area, so you would know.
I know it. I used to live at pizzas around the whole of Blacktown. I know every street.
Know, and your mum would know, and your forebearers would know exactly where water goes when there's a lot of water.
Yeah.
It's just insane.
Yeah, and big consultation and this and that. Nothing.
With who? With who?
Oh, the public. I sent them a note, pretty much going, why you decided to change this, and are you going to? You need to compensate me for this, which means probably going to have to pay higher insurances, and you probably devalue the property.
100% they would have.
Compensate me. Nothing.
No chance.
So Blacktown Council, you think you're one of the fanciest cities in all of Australia. You're the heartbeat of Western Sydney, and you're letting your ratepayers down. Blacktown Council, give me a call. I'm sure you can find me. Anyway, Fast 50. This is what you've got to be thinking about, Paul. That's not cool.
No, but the irony, Phil, is that we're going to go through some suburbs across Brisbane, which anyone who's owned investments or lives in Brisbane as an investor or an owner-occupier would know full well that the 2011 floods, what superseded that was exactly the same thing, which was a very fancy consultant report that came out and basically said our new 1 in a 100-year event, flood event, is going to change. Even though the vast majority of where those 1 in a 100-year event mappings changed didn't have any water on them. They said this is where water can go in that event. Well, apparently that event just happened and the water didn't go there.
Do you know the problem I've got with this Blacktown Council is there's a stormwater, right? The original creek, it used to be Dairyland back in the day. It's been stormwater, right? Yep. They said in their notification the reason why they've changed it because of the ongoing development of the area has changed the flow of water. So they're saying because they've developed more so they can get more ratepayers' money, So there's more people that change the surface area. Therefore, the potential of water, what's called water ground runoff.
Typically
or
the
something
overland
like that.
flow as well.
Overland flow.
Yep.
That's what I'm looking at. Overland flow has changed because they've developed it and they haven't been able to keep up with the development. Spend more money, Blacktown Council. You're hitting ratepayers hard. It's not fair. Anyway, there's some questions here, Paul.
Poor Blacktown Council.
It's not cool.
No? Huh?
No. But the point is,
What is the point, Phil?
the point is, local councils is where the rubber hits the road on supporting affordable housing and development.
They
This
genuinely
is the
are.
point,
Yep.
right? But you got to do it with, Blacktown Council. You got developed areas, then you got greenfield sites, right?
Yep.
Everything you do has cause and effect, right?
Yep.
I get that. That's right. But they've got to open up the gateway for building more properties to keep
Well, the
housing
irony,
affordable for the punters.
and the irony of these zoning changes into your Blacktown City Council market or a lot of these Brisbane markets is once they change these overland flows, what it does is because the zoning doesn't support higher density, then all of a sudden you take out of the equation a whole bunch of property that could otherwise be developed to provide more supply. To this point of we need 1 million houses in 10 years. Well, you know what? You've just gated a huge amount of property that will never get touched. So what you've done is essentially take more supply out of the market and effectively take more rental supply out of the future rental supply market as well. So private enterprise can't do it because the property you owned, which could be duplexed potentially at some stage.
Yep. Or
now
put a
can't be.
granny flat on it.
Granny flat, anything.
Stuffed.
They will limit it.
Stuff me.
So all of a sudden that's stopped the ability, even if we were just owner occupying looking to put a separate dwelling for your kids to live in or whoever, in-laws, etc. That can't happen. And these are the things that the cause and effect.
Good luck trying to get an answer.
Yeah, well, that's the other point. To my point, reaching out to the mayor,
Lismore
you're reaching out
Council.
to Lismore Council, Brisbane Council, Blacktown Council. That's all the same because the bureaucracy just stops you being able to have a human conversation with someone. Moving on.
I'm shaking my head. Anyway, I've been ranting for 21 minutes. We haven't even got the one question.
That's a good rant. That's a record rant, I reckon.
It should be. Someone's got to do it.
Yeah, true.
Someone's got to police the bureaucratic idiocy
You're
that's
very
going
Ray
on in the
Hadley
world.
these days,
You
aren't you?
reckon?
You're sitting there staunch. You don't have the same paycheck he has,
No.
unfortunately.
Yeah, well,
He does live in Upper Dural, I believe.
he does. He'd be investing in property.
No doubt.
He'd be investing in property. Hi, Philip, is the first question. You notice how they all say it to me, not you.
Not all of them.
Oh, maybe.
Well, you did send the email.
This is true. I did send the email. Hi, Philip. I think the report is pretty spot on. Here we go.
Yeah.
This is good. And by the way, I've only skimmed these. So
Affirmation,
yeah,
will you?
I've only skimmed these.
Cherry
This is not
picking.
biased. And like other investors, I think do you know what's really funny? I'm really not good at reading out loud. I think I am about to hit my limits, and the amount of red tape the banks are putting on investors are just counterproductive. There has been 2 times in the last 3 months where I've missed out on opportunities to get my hands on 4 to 5 unit sites, and the banks turned around and said no to the development because they classified it as, inverted commas, commercial, aka the total development cost is only like 700,000 to 800,000, so not even that big an amount. How you guys came across issues like this, and how did you get around it so that you can get ahead with development? This is best regards. I won't use last names, but this is Danny C. Thanks for writing in, Danny. Appreciate that. This is probably more your sort of neck of the woods. So this is, you'd be sniffing out sort of 4 to 5 unit development sites. That's gold dust, because that's the sort of developments that investors that have been around a bit and done a bit, want to have a crack at because it's not too big, but the limitations sometimes, as soon as you get bundled as a commercial, there's positives of being bundled into the commercial realm and there's negatives with it as well.
Yeah, you're very right, mate. It's typically for anyone who's sort of considering, when do I potentially want to make that step into going and buying whether it's a boutique old unit block, a 4-pack, a 6-pack, 3-pack, or alternatively, if I want to buy a big block of land and build 3, 4, 5, 6 dwellings, whether they're duplexes, units, townhouses, etc. There's policy with banks, and they're not all the same. And this is where it comes down to really, really, really understanding and getting a great broker on your side early in the piece to give you this feedback is extremely key, because if they know, essentially oils ain't oils, if they know what they're looking for, they will be able to guide you correctly. The reality is funding's available for pretty much any site at a price. That's what it comes down to. But if you're going to be playing with the majors or even tier one lenders, you'll usually find that once you get beyond three or beyond three properties, individual titles, whether you're going to buy them up front or you're going to develop them, that's when you're going to run into commercial finance. Typically, you'll find also then commercial finance puts you into a different realm as far as required upfront money. When you're talking about required upfront money, you're typically finding that 70% LVRs usually going to be the max you're going to find, and then it'll work backwards from there. You're going to find that you're going to pay probably 1.5%, 2% premium for a major or a tier one, and then you go down to tier two, tier three private funding, and it could be anything up towards 5%, 8% increase on the retail rates at that time. So the key there for me, anyone who's sort of considering this, and Danny in particular, sort of realising that getting your hands on these sites, you're going to find that you're playing with players who have got their, for the lack of a better term, got their shit together. This is really where you've got to have a very clear funding game plan prior to getting involved in this stuff. So don't think that you can just go and buy it, or find it rather, and then go to your broker saying, hey, put a deposit on this 4-pack. It's going to give me an 8% yield or 10% yield, and it's got its development overlay. All good things, fine, whatever. Don't even bother until you really know what those funding requirements are going to be. So get in touch with your broker. If you don't have a broker who understands that and plays in that space, hunt one out and find them, because they are going to be vital to supporting your portfolio build from that point onwards.
Yeah, another play with this, Danny, and I know a lot of investors do this. They identify, I think you spoke about this site in Mandurah that you just bought.
Correct.
Right? It's like option trading around property, right? Yep. So you buy the property as a residential asset, standalone residential asset, but the option is that you can develop it, but you might not necessarily be the person that developed it.
Correct.
So I know a lot of people have made a lot of money being ahead of the curve, buying sites which may be getting rezoned, or buying sites where that does have development appeal, and just sitting on it until a developer, like an actual developer, wants the site.
Yep.
Because what they do is, if the next door is also owned by a property investor, this when developers come in and they buy 2, 3, 4 side by side, and they build 50 units on it, right? And you see
100%.
it, greenfield stuff along the train lines is happening in Sydney, for example. It's happening by the day. So you can still do this, and the bank will lend you money against the residential asset, not considering it could be a development block, and then you just sit and wait.
Yep.
Sit and wait. Let someone else take the risk. But you might get an uplift. You might be able to double the value of property over a period of time if there's an acceleration of development.
Completely. And I think that probably my last word on that scenario there is that property development gets glamorized quite heavily for rightly and wrong reasons out there in the public. And Phil, you've renovated, you've developed property. I personally do it actively, ongoing. But I've also had my experiences of failing at it. I've had my experiences of realizing that buying the asset and doing nothing with the asset is sometimes far more financially viable than actually actively doing it, and then thinking about all the other things like liquidity. I'll give one example before I finish up on that one. I've actually recently bought a 1,100 square metre site, southern Sydney, R3 zoned. We're going to be putting 4 detached properties on this block. Now, we paid $3,050,000 for this block 2 months ago. That block, it neighbours 2 separate blocks which sold bit over 2.5 years ago, exactly the same zoning. They were about double the size. At that time, the developer who bought these 2 adjoining properties offered the person who owned the property that I bought $4.5 million for that property. Now, they didn't want to sell. They thought that the property was worth more. They had their own reasons. What ended up happening is that the developer bought those 2 properties, maximised that block, built a basement, all the other things, built about 12 separate boutique high-end accommodations. That ended up isolating the site next door. So by not accepting that and thinking their property was worth a lot more, they lost. Now the market's probably come back 5-8%. So let's say they lost 20% from not taking that then at that time. Now they bought and held that property. They had no intention of developing it. They would have made 4x on their money from buying that property about 20 years prior. Sometimes doing that assessment and realising that a bird in the hand is far, far, far more valuable.
Well, it can be very restrictive, and I have another example of that. But talking at that point, if someone does a massive development next door to you, and that's sort of, say this, you're talking about three blocks, 2 of them get developed, and the one's left, right? the person that built that block and the people who buy those properties are going to fight tooth and nails to make sure that another big development doesn't go up next door because, number one, it devalues their properties because there's more choice and they're newer properties. Number two, if people have got balconies and livable areas on these joining thing, they're not going to want another similar size block next to it. Number three, the local governments change the rules all the time. A shared friend that we have bought a site in the inner city of Sydney. I won't sort of give specifics on the council. I was Leichhardt Council. I'll say the council. And on the basis that to build a duplex on it, right? This whole street is full of duplexes.
Yep.
All full of duplexes, right? So we bought this, we did his pre-feasibility stuff. He's
and he's not
his architect.
unwise on it.
No, he's done stuff before, right? And he put it in for council. The council went, no more duplexes. And he went,
We've reached our quota.
He went, but everything else is duplex. Are going, yeah, we're going to change the rules, and therefore we're not going to approve your duplex but you haven't changed the rules yet. So approve it. And they're going, no, but we're going to change the rules. So no duplex for you. And he fought it, couldn't get it.
Yep.
And
so potentially
nothing's guaranteed.
A wedge of money from that. Yeah. And again, out of your control, do all your DD, but you do take a risk. And I guess going back to what I was saying about developers, you take a lot of risk developing property, an awful large amount of risk. And this goes back to, you've got to make these, what we opened this conversation with about whether it's federal, state, local council, governments, it's not streamlined, it's not simple, and it's high risk. And the only people who are out there actually trying to provide accommodation are the ones who are prepared to take this financial risk, and they're doing it on their own volition. There's no backstop.
And I'll tell you what, you only hear the good developer stories.
Yeah.
There is usually less good stories than good stories. And a lot of these builders going bust, a lot of them are doing development plays themselves, right? And that's what normally sinks them.
Correct.
You only hear the good stories. There is often more bad stories, and your whims of the market, your whims of the government, your whims of interest rate environments. There's a lot you can't control if you're developing. And people always go to me, Phil, why don't you develop property? You should be developing. You know all about property. I go, nah. I just don't have the time.
Yep.
If you've got to do it, it's got to be a full-time play.
Correct.
Right? It's got to be a full-time play unless you're absolute. And I'm sure if that's all I did, I'd be a really good property developer, a property developer. No question. But I just don't have the time.
But you have to be all in to really understand it. Yep.
Don't have the time. Anyway, that's why we do podcasts. Hi, Phil. Great podcast and report. Writes Jake P. Thanks, Jake. What data/characteristics were given the highest weighting? Here we go. This Jake knows. He's curious. I know a lot of areas in the list are places that have had relatively low growth in the last 5 to 10 years. So I assume average annual growth isn't a big factor, e.g. lots in Perth and regional Queensland. It's a good question, Jake. So this methodology, and I'll quickly summarise it. We went to all those people we spoke about. There's 1, 2, 3, 4. There's 14 experts, right, that work across property from all different areas. So you've got economists, you've got buyers agents, you've got heads of large real estate networks like John McGrath and Angus Rain, and then you've got people that work in and around property, other property strategists. So real mixed bag. We said to them, tell us, there's 20, wasn't it? Tell us give us your 20 top suburbs for capital growth over next year. And that was pretty much the brief. We didn't say you need to base it on this. We said, you tell us what they are. Based on how they would do it for their customers, their clients, their awareness, the way they do it. Data people would use data. Buyers agents would do it differently, etc. So that was completely unorchestrated. It was like, you just tell us the suburbs. You tell us the suburbs. And then what we did, we matched those suburbs. So how many of these panel participants said the same suburb? And you just go, if every single person says the same suburb based on how they go about working out what the top suburbs are, it's probably a good location, right? So there's the aggregate idea of all these people using their proprietary way in which they assess suburbs. So that alone is pretty significant. That accounted for, by memory, Paul, 60%.
It was more than 50% of the weighting.
60% of the rating.
So that was the
67% of the rating.
Yep.
Maybe 70% of the rating. 67%. Anyway, I'll work through that. Okay, and then we said, okay, let's turn to the data. So you get all these suburbs, and there was 178 of them, all recommended by these experts. So we had to get 178 to 50. So how do we do it? Okay, let's do a data overlay. And the data overlay, we said, okay, how do we work? All of these suburbs, 178, are all good.
Yep.
They're all good, but we've got to turn it to 50. So we said, well, let's turn to the data. Okay, what's the thesis is where to put your money today for the best capital growth in 2024. So what do you need to look at? And this is where we debated this pretty hotly. And we said, what's been the most recent quarterly growth?
Yep.
And we weighted that pretty strongly.
Yep.
Then we said, what is the 10-year average? Then we said, what is the 12-month growth, 1 year growth?
Yep.
How much has it moved in the last 3 months? How much has it moved in the last year? Then what is the 10-year average annual growth?
Yep.
And then what was the rental yield?
Yep. And in that order, descending.
In that yield.
Yeah, so much higher weighting to recent 3-month growth.
Yeah, so 3 month was the highest, then 12-month, then 10-year average annual, and then yield. The yield was, look, yields are pretty good all over the joint at the moment. So it was really just a rounding, right? It might have changed a little bit.
It's probably just to give a bit of gravity to, if you were interested in that market, what's the yield of that market to a degree? Because we're not talking about what's the best yielding suburb for 2024.
That'll be a different ranking, no doubt. So the 12 months. So what we were trying to look for was the relationship between how much has this property moved in the last 3 months and year versus the 10-year average.
Yep.
And if it's up and accelerating, there's some significant clues there. So if the 3 month is really high, the 12 month is lower, and the average annual is even lower than that, there's some clues there.
Yep.
So that's how we weighted it. And that's how we come up with the 50. So the question is, I know a lot of the areas in the list are places that have had relatively low growth in the last 5-10 years. So I assume the average annual growth isn't a big factor. Absolutely.
Correct. And when you say average annual growth, it depends on how long, because we've talked about 10 years, but it's sort of availability of data to get your hands on too. I mean, a pure property investment, we can get our hands on 20-year data, but then you've got to dig a bit deeper to granularize that. And when it comes down to it, what we're talking about here, when the crux of this Fast 50 guide are where to put your money for the best capital growth in 2024. So we're not talking about for the next 10 years. We're not talking about for the next 5 years or 25 years. We're talking about where we expect what markets, based on the data, once we've summarise them down to 50 markets, which ones we expect are going to perform best.
And you see how that plays out. Let's just do it. And if you watch it on this video, this is completely random. I'll just pick up anything. Here we go. It's like playing cards. Churchill, 3842 Victoria. Okay. Average annual growth, Paul? Median quarterly growth, 0.7%. Average annual growth, 8.1. 12-month growth, 20.7. So it's grown by 20.7 in the last 12 months.
Yep.
It's only grown by 0.7 in the last quarter, and its average annual is 8.1. So that's probably getting towards the back end of its run.
Correct. I would personally suggest that as a market, as an investor, if I'm expecting strong growth over the next 1, 2 or 3 years, that's probably not where I'm personally expecting that outcome. Now, that's not to suggest that the next 10 years won't be good, but don't think that's going to be as opportunistic as the next.
All right, here we go. Maddington. This is 6109 WA. Average annual growth, 2.4.
Yep.
12-month growth, 10. And median quarter growth, 2.3. So that's still growing at 10% annual.
That's a graph of the last 12% annually.
Yeah.
So if I'm looking at that, that's the last 1 year of growth. And if anyone could see that on the interweb, that is a pretty strong hockey stick in the right direction. If I'm looking at 1 year, you'd look at that again in a visual representation though.
Yeah.
You start to realize that the last 10 years saw it basically.
So it's just gone back to where it was.
It's just passing its 10-year previous peak.
Yeah, it's crazy. Isn't it?
And then you start to think, oh, hang on a second. Might think I've just bought into 10 or 12% annual growth. Well, start to think it from a 30,000 foot view, and you realize, hang on, you're still buying value here. Don't worry about what happened in the last 12 months. The propensity's strong, and the opportunity and the value is still quite strong as well.
Yeah. Okay. Here's the last example here. Paralowie. Is that right?
You've chosen the best one there. I think you tried to pronounce that. It's in South Australia. You tried to pronounce that last time around as well.
Paralowie. Is it? What is it?
We'll go with that.
What do you call it?
We'll go. Look, it's not a market that I'm buying in, but I'm
5108 in South Australia. Paralowie. Sound Paralowie.
There you go. Yeah, you twang the accent out.
Yeah, there we go. Median quarterly 3.1.
Yep.
Average annual 5.9.
Yep.
And 12-month growth, 20%. So that's had a
good 10 years.
Yeah, show me the graph.
That's your 10-year graph.
Oh yeah, look at that. Show people on the interweb there.
So if people look at that, And then you say, okay, well, hang on, draw some parallels. Up until about 2020, that market was pretty insipid. And then you say, okay, well, last 3 years, and so it did 95% growth in the last 10 years on data, on RP data. Last 3 years, it did almost all of that, so almost 70% in 3 years. So personally speaking, yes, hey, the last 3 months and the last 12 months still looks quite attractive.
Should have been there yesterday.
Yeah, you kind of say, well, do you expect the next 3 years to represent anything close to the last 3 years? I'd highly doubt it personally.
Yeah. All right. Okay.
But that's good.
There's a whole bunch of,
yeah.
and there's some real specific suburb questions. We'll get into them. Let me just get through some of this other stuff. Here's a question here. This is from Jeremy Shepherd. He's a property data
I'm pretty sure he is. Yeah.
person.
Yeah.
Jeremy Shepherd.
DSR score.
DSR score. There you go. There's a plug.
Yeah.
My question is, what expert picked each suburb? Not telling you.
I'm pretty sure Jeremy would be able to get the phone numbers to each of those experts anyway. So if he wants to ask them individually to get on the blower.
Yeah, and look, I don't want to do that because a lot of these people keep this pretty tight. Yeah. I know what they are.
Yep.
I know what they are, but I'm not going to share them. I've shared them at an aggregate level, and that's the beauty of this, right? But like, mate, I'm more than happy. You can tell people what you voted for.
Yeah, look, I won't get rattled through sort of case by case, but I mean, if I look at sort of the top 20 that myself and also our senior buyers agent, Lena Lindley, both contributed our markets and suburbs that we expected, they probably range depending on budget. So as low as 300 grand, as high as about 1.5 million. So it's not to say, hey, we just target one particular investor. They probably split, majority were about 20 to 30% in the broader Brisbane market. There's probably another 30 to 40% in the broader Perth market. And there was a couple of small selections in Sydney and also Melbourne / down towards Geelong region. So if I look at the spread of our contributions or across those markets, we didn't have anything in SA or in Tas. Look, we bought a lot in those markets in previous years gone by. Similar to Canberra and the ACT, we're not doing anything in Darwin and Northern Territory, and nor are we buying regional Queensland.
Cool.
But all those markets are represented in there in some way, shape or form, but just not by us.
All right, there you go. Another question. Hey, mate, my question is in regards to the property market as a whole. Is the rapid level of growth we've seen in recent years sustainable? Is there any chance we are in a bubble? Thanks for your time. Hope it gets a feature. Well, certainly have done, Hugh R. We sort of touched on this earlier about, I guess, the integrity of the Australian real estate sector. I'm chatting with some buyers. I even mentioned Steve Waters just the other day. I'm quite keen on your view on this, Paul. His view, their view, over at Right Property is pretty much going, everything points to sustained growth in property into the future. The only outlier is liquidity at the moment, access to money. And their view is that if that access to money and that liquidity thing is solved, which could be as simple as removing those 3% buffers on someone lending, that will give a lot of the momentum for they're not talking like ridiculous prices, but sustained growth moving forward. And I tend to subscribe into it.
Unequivocally. It's funny. It brings me back to a conversation I personally actually candidly had with Steve over the phone about 3 years ago. And this was just, I believe it was...
So all you guys talk to each other,
absolutely.
All the good buyers agents talk to each other.
Absolutely. We talk regularly. I mean, there's a number of people in there I speak to regularly on a professional basis and just generally just friends because they're just good people. And I'm curious, and also just we have conversations. But when it comes down to the market over the last 3 years, and it's a huge comment here that the last 3 years in particular has been a very good and sustainable big boom. It has been. There is no two ways about it that 20, 25, 30% annual growth over a 2 or 3 year period is not sustainable. And anyone who's bought 3 years ago and thinks I'm going to buy another property and I'm going to be upset if I don't get that same return in 3 years, don't buy property because you're not going to get it anywhere, in my opinion. That being said, and to your comment about what Steve said, we had a conversation, as I was saying, about 2.5, 3 years ago when we started to go through this interest rate cut cycle, and we also talked about what is happening essentially out there in the market at that point in time. The market segment was low supply, low unemployment levels. The vacancy rates were on a pretty clear downward trajectory, and almost every single state and territory was looking quite good economically. And we looked at it at that time, and I remember we had a discussion to say, mate, where do you see things going over the next 12, 24 months? And we both unanimously said, mate, we think we're probably going to be landing in a pretty heavy boom right now. And I remember at that time too, we both were gearing up to buy more property in our own portfolios because there's certain times where you just see there's opportunity. And once you do this enough, you realize that there's only a small couple of levers that can ever be pulled that change the outcomes.
Yeah.
Liquidity and cash is typically number one or number two. Supply is the other big one. We went through 2015, 16 in particular. There was a lot of building approvals that happened right up and down the East Coast then. And anyone who's bought, unfortunately, probably off the plan units or apartments in Brisbane or even in some of these more prime areas of Sydney and Melbourne would attest to the fact that their properties have probably done nothing because there was a huge supply issue. And building property was actually quite simple because funding was getting cheaper. Banks were happy to lend. Then went through the liquidity crisis through the Royal Commission of the Banking Sector, 2017. We saw property nationally went backwards 10% because liquidity was cut off. We saw the same thing happen in the last 12, 14 months where we saw interest rates rise 4%. In a very short period of time. Liquidity has been turned off for a lot of people. Property went backwards 10, 14%, 15, 18, 20% in certain cases. Certain areas in very, very heavily located lifestyle areas, Byron Bay is a good example, down a bit further south, Gerringong, Taroa, Kiama. There's a number of those markets in every single major state and territory. Those markets are being hit the hardest right now because people are realising that A, they can't live in these areas permanently. B, we're starting to see that holiday rentals are falling off a cliff, and now we've got interest rates rise 4%. So cash flow and funding those starts to go. So those areas are the ones that are going to coming off. To that point, next 5 years, 10 years, I expect we're going to see mean reversion. Mean reversion, 6.5% average annualised growth. If we had this podcast in 2032, 2033, in 10 years' time, I would expect that we're going to see some bumps in the road, some really big years. But again, we're probably going to see somewhere around about that 6.5%. So don't be distracted in short term. If you can afford to hold short term, think about long term.
Even in those places like Gerringong, Kiama, Kiama was like a boom area.
Yeah, you're talking those markets went up 40, 50% annualized in a 12-month, 24-month period, even 70, 80% in 12 and 24 months. Yeah. I personally would be wary if you held property in there right now that you're going to get that same level of growth. Yeah. But I guess the only good thing about anyone who's bought their second or third home in those areas, typically they had the cash to probably sustain it. But don't expect that there's going to be a rebound around the corner. They're not coming.
They're not coming. No, not for some time. But, you'll see if you think of those areas, Wollongong Way, which is it's all commutable.
Wollongong different, yeah. But you're talking, Gerringong, Taroa, just as an outlier example. I recall seeing places.
A place like Berry went through.
Berry,
through the
again,
roof.
classic. You're talking sort of, quarter acre blocks, good old school blocks, and those were properties that were selling $400,000, $500,000, $600,000, $700,000 4 or 5 years ago. Those properties went to north of $1 million within a year or two, and these were all, the demand was from Sydney-siders exiting because they thought, well, I'm working from home, working remotely, my job's secure, money's cheap, and I can't buy a house within 30 k's of Sydney for this price. I might as well buy it here. And now all of a sudden, your business at Momentum, Phil, is a classic example where your team's coming back into the office, and that's going to be vast majority of these businesses. They're going to demand people to say, hey, we need to work collectively in an environment, and you can't do that when you're an hour and a half, 2 hours away every day. You just can't do it.
Well, this is why I always, during that period when everyone went nuts, buying these lifestyle properties like in Byron Bay, right, and Federal and that sort of areas going. I get the lifestyle piece, and I think there will be an inherent attitude towards more flexibility for people moving forward. But you've got to be in striking distance of a capital city. Yep. If you can't get to a capital city in less than an hour and a half, even less,
it's going to be hard.
It's going to be hard. So go for the lifestyle, and those lifestyle locations, which are in those areas, and I think of further out west from Dural. Dural's still a strong, really, really strong market,
it's commutable.
Right? It's commutable. So
Correct.
Lifestyle locations in striking distance is huge. And that's why I think the belt from Wollongong to Sydney will remain strong. And I think the belt from in the Central Coast will be strong. You've got this whole 6 cities thing in New South Wales. Right? I don't know how familiar you are with it, where the Gong, Illawarra, Central Coast,
Parramatta, Liverpool.
Livo, those areas out there. There's going to be big global cities in their own right.
They are.
And even now, if you put Wollongong on a global, so if you put Wollongong into America, it's a big city.
Absolutely.
It's a big city. So this way it is. The question here, we'll look at it really quickly. There's no name on it. It says, hi, Phil. I was hoping to see the previous forecast, how the previous forecast performed in the market. Is this something you guys are able to discuss in this podcast? Yes, we'll discuss it. No, I can't give it to you because this is the first time we've done this report in this capacity. So this time next year, we'll see whether or not how many of these people got it right and wrong, and whether or not this report was right or wrong. So I look forward to doing that. That will be interesting. to just see how this performance has actually taken place. And you got to remember, it's a moment in time. Don't always get it. The RBA governor thought interest rates weren't going to go up until 2024. And
He won't make that mistake again, will he?
No.
He's not going to be able to.
I don't think so. I think he's only got 3 months left,
Yeah.
right? So 3 more interest rate rises.
Yeah,
come.
exactly.
How many more is going to happen?
Mate, we've talked about this on Property Finance Uncut a few times, and we've probably got it right a few times, and we've probably got it wrong a few times, to be honest with you. I think the reads, it's a complicated one. What I'm confident with is that within the next 18 months, we're not going to pay the same interest rates that we are right now or will be for the rest of this year. So whether that means 1 or 2 more, even 3 more rate increases between now and the end of the year, again, going back to focus on probably what your money's going to be able to, if you can afford to hold assets now, based on income, based on rent, be comfortable that you're going to be able to afford it in 2 years because in my opinion is that that's going to get a little bit more affordable in that time.
Okay, so let's 10 or so. We can do a bit longer. It's okay. I'm sure everyone will be all right. We'll go through. I won't read out. These are more sort of suburb-specific questions, Paul. Adam W. Writes in. He's a sales manager. Thanks, Adam. I won't go through all the glowing stuff he says about how good I am on the podcast, Paul.
Right.
But his question is the suburb of High Wycombe. Did I get that right? Wycombe?
No, Wickham.
Wycombe?
Wycombe.
High Wycombe.
High Wycombe.
High Wycombe, 6057. I have a property here near airport close to Forestfield. Any thoughts on this as a suburb? Is this suburb has the fundamentals for growth? What do you reckon?
Yes, in short. Look, it's certainly a market that's we suspect over the next 5 years, 8 years is going to perform consistently well. High Wycombe in general over the last 12 months has done about just short of 4% compounded growth. Over the last 3 years, it's done about 16% over the last 3 years. Majority of the growth that's happened has happened in the last 18 to 24 months. And it's a market that is highly undersupplied. It's within about a 20-minute train commuter straight to the Perth CBD. Forestfield Airport's been upgraded as of the last year and a half, 2 years. That was about a 5-6 year project, and that's taken basically people from equivalent of, let's say, 40 to 50 minute drive in peak hour via train, 20 minutes straight to the city.
So by geography, airport
go straight line to the city.
Turn right on the right hand side of the airport is High Wycombe Forestfield, is that right?
Yeah.
And there's a train station chucked in there and then you can get to the city.
Exactly. And that pretty much is a beeline straight to the city. And it's only, you get a fast train there, 3 stops, you're in. And you know, for anyone who knows Perth or any other major metropolitan city in Australia that's got 2 million people or more, having those kind of commuter belts, it's valuable. It's highly valuable. And that's where, you know, there's a number of markets around High Wycombe, Forestfield, et cetera, that as a company, they're probably giving away, you know, where we're buying, but you know, there's no shortage of those markets. We've bought in.
Don't tell them.
But they've done well, and they will consistently do well, and you're sort of still achieving 5%, maybe even more of it from a rental yield standpoint. So good quality freestanding houses, $500,000, 5% or better yields with good sized blocks and good commutability. All
right, cool. Question here from Murali. Thanks for writing in. Some really encouraging stuff about what we're doing. I would like to know a bit more about the suburb Wellard, its selection methodology, factors that are contributing to being in the report, any other important factors to highlight about the suburb that helps us to say it is a future growth suburb in WA. You like Wellard, Paul?
Don't mind Wellard. Again, quite similar when we're looking at sort of certain areas across that Perth metro market in general. Wellard is probably more of I'd say it's probably more of that commuter belt south of Perth. So you're talking sort of about 10 minutes inland from Rockingham, a little bit further up from Mandurah, but you're getting very good value. You know, seriously, you're talking 400, like we talked about, where you can build a property for Wellard. You can still buy assets there, freestanding established houses, circa 400 grand. You're getting 4.5%, 5.5%, 6%, some cases north of 6% gross yields, but you're buying a lot of property below replacement value. So you're 10 minutes to the beach, you're on a 2 major highways straight to the city, and you're essentially got a lot of... So one thing that Mandurah and Rockingham have, which probably people don't understand unless you've been there, they've had essentially a disadvantage for other markets, but they've had a disproportionate amount of money put into their civil infrastructure. They have a huge amount of decent both hospital, university, high school, public school infrastructure, which typically is only afforded to sort of 50 to 80-year-old cities. It all exists in these types of areas. So you've got very, very good infrastructure. You're still only an hour from the city. You're 10 minutes from the beach. You're within good, close striking distance of a couple of decent suburbs as far as employment hubs, and then you're only 45 minutes down further south towards Busselton, and you're a hop, skip and a jump from Margaret River wine country as well. So you've got some really, really good connections there for 450 grand.
Yeah, Willard's recent popularity lies in a status as Perth's first transit-orientated development on the Perth to Mandurah rail line.
There you go.
There you go. The numbers, Paul, median quarterly growth 2.6%, average annual growth 2%, 12-month growth 7.3%.
Yep.
So
and it's growing.
It's growing. Anyway, you can hear me rustling papers there. Here we go. Another question from Hilda C. Thanks, Hilda. Hilda writes, there are many markets inside each market. There are pockets for growth. We have properties in some of the locations mentioned. We compare a couple Paralowie with Christie Downs in our experience. Christie Downs has a fastest growth than Paralowie. Your parameters are similar for both suburbs. Why one makes a cut and not the other?
Yeah. Like when you're looking at those areas, if we're talking, so Christie Downs is a classic example. We actually bought a lot of property in Christie Downs about 3 or 4 years ago. So we did not, again, I said earlier, we didn't recommend.
Christie Downs was actually in the 178. So
it was.
I remember seeing
it certainly was.
Yeah.
And again, we bought a lot of property in that market and a lot of property sort of nearby, Hallett Cove, Happy Valley, and a little bit further.
Is that where the race course is?
It is. That's the Trots there.
Yeah.
And then further down towards places like Seaford as well. You're not far from the hills of McLaren Vale and whatnot. So not dissimilar to what we're just talking about with the WA side of things with Margaret River. But a lot of value in that area. And if you're sort of trying to compare, and this is probably a bit of a recipe for this whole Fast 50 guide, if you're trying to compare one suburb versus a neighbouring suburb, you're really trying to compare apples and apples. Like, you're splitting hairs here. So don't necessarily get too bogged down with one specific suburb. So if you're seeing a suburb and you're seeing that the data looks quite juicy, and then you're trying to say, hey, there's another market here that's pretty similar and not too far away and has pretty similar connectivity, you might realise that, hey, look, you could probably maybe just concentric circle about 3 or 4 different suburbs around one, and you might find some similar outcomes.
It's a really good point there, because it's really connected with this next question. This is from Michael Gillian. I'll say he's a trainer assessor. He's a fully licensed real estate agent. He also says some good stuff about the report. He says, as I live in Brisbane, I was particularly interested in property investment in Ipswich, Queensland. My questions are, have you chosen investing in Ipswich for its affordability? And what advantages might investing there have over investing in other greater Brisbane areas like, I've never heard of that place before, Inala and Forest Lake. So the context here is that when we first did this report, and I saw the first run of all the numbers, I had Ipswich as an area, and I went, where in Ipswich?
Yeah.
And I went, someone specifically said, so go and try and find Ipswich. It's Ipswich is like a collective of a whole bunch of places. So we went back to a lot of people and said, you've said Ipswich, but which suburbs?
Yeah.
Which suburbs?
Because Ipswich itself is, Ipswich City, you could buy in Ipswich, but Ipswich is a very, very big geographically. I think Ipswich local government area is, I think it might be the 3rd or 2nd biggest local government area in Australia.
It's like the size of Wollongong,
It's
right?
enormous.
Yeah,
it's
to give some sense for it. So you've got like Bellbird Park, you've got Collingwood Park, you've got all those sort of joints, right?
And then, the question talking about, compare it to other areas like Inala or Forest Lake, which both in turn actually aren't that far from Ipswich itself. And
I think Forest Lake made the report, didn't it? Or
Possibly
maybe it made the short list.
I can recall dozens of properties I bought in that area sort of about 5 or 6 years ago, to be honest with you. But I guess to the point, and the question, areas of Ipswich in general, there's quite a number of suburbs, Raceview being one of them. I think there might be, without seeing the report in front of me, there might be 2 or 3 others. Brassel might have made the cut in there as well. These are areas, certainly affordability fits the bill here. And going back to what we were talking about with construction costs earlier, you can still buy a 4-bedroom, 2-bath, 2-car garage house on a 500-600 square metre parchment within some of these suburbs for $500,000, $550,000 in some cases. So you're essentially buying the land for maybe $100,000, where land is probably costing $250,000 to buy the equivalent land in the same suburb. It's not necessarily just an affordability conversation, though, but when you start to look at what Ipswich and Ipswich local government area offers, it offers a lot. When we're talking a little bit similar towards that sort of Mandurah, Rockingham area, there's a disproportionate amount of infrastructure in places like Ipswich. So you've got public school, private school, multiple university hubs. You've got the Amberley RAF base, which is a huge employer, a massive anchor employer forever in that market. You've got multiple train lines, highway access. You've got access both to Brisbane CBD down towards Gold Coast as well. But you've also got a huge amount of other employment hubs that sit directly within that Ipswich area, and you've got it in an affordability constraint. If we talk about supply, though, anyone who bought property in Ipswich in general, for those classic off the plans, defence housing, DHA, there was a lot of that going on in Ipswich probably 7, 8, 9, 10, 11, 12 years ago. There was too much supply then released at the same time. Ipswich Council has had their mayor sacked twice. There was a bit of corruption in there from memory, a lot over the last 5 to 8 years. But supply has dried up. So where they were in this position where they had heaps and heaps and heaps of actual greenfields land being released, that's all changed now. So it's a lot more established property selling for the second or third time. So why that market's now, and anyone who looks at data in those areas, they would have seen that the last 2 or 3 years has been exponential growth versus the last 10 years of very insipid, in some cases, no growth at all. You're starting to get this point now of actual limited supply versus where the demand is, because it's affordable, there's jobs, there's connectivity, and it's ticking all those boxes.
There you go. I hope that helps, Michael. And I'll read this next question because they put some thought into it and probably a good insight into how other people are seeing the world. This is from Kelly and Carl S. They're from Boona, Boona. Do you know where that is in Queensland?
Boona.
I don't know. There's a lot of places I don't know. Hi, Phil and Paul.
B-O-N-A-H, is it?
A-H.
Yeah, correct. No, that's very regional.
That's where they're from, yeah. This is Kelly and Carl. Thanks for writing in. My husband and I were looking into locations in low-end price brackets, sub $400,000, due to serviceability caps and looking for positive cash flow before interest rates started moving up. We had pinpointed Warwick, Queensland as a possible location for our next purchase, and lo and behold, it turned up in the Fast 50, which surprised us. Good work. I know the experts have touted prices will rise in 2023-24, but my concern about purchasing in such a regional area with previously very little price growth, ageing population and no major jobs growth would be a long-term 10-plus years capital growth. I know prices are low and can only really go up, and rents are growing, but I'm still not sure. What are your thoughts? Thanks for understanding podcast. Appreciate the available insights, learning, and awesome guests. Well, thanks, Kelly and Carl. A lot of people invest based on what they can afford, and that's not a bad way to go about doing things, right? There's no use considering 1,000 different locations and you can only afford in a handful of them. You must see this a lot with your clients. And one of the reasons why, well, when probably about the 8th cut of this particular report, they were actually in order from 1 to 50 based on all those metrics and the methodology that we put together. And I sort of thought about it over the weekend and went, no, I'm not going to do that.
Yep.
I'm not going to do that because if the number 1, number 2, number 3 suburbs based on the methodology are $600,000 or $700,000 plus or $500,000, that's going to price out a lot of people who can't invest in property. Therefore, the report becomes redundant, or it negatively frames their sentiments towards it. So we went, here is the 50, and there's price brackets inside of it. So to this point around that Kelly and Carl are writing about here, Willard, I'm not really familiar. Warwick, sorry. Yep. I'm not really familiar with the place. Do you know it?
It's a quaint regional market of Queensland, about 2 hours or hour and a half from Toowoomba.
Okay.
I'll frame it this way, and I think for me, not speaking specifically on that suburb, but speaking specifically to what to expect over the next 10 years. And I don't want to burst a bubble here to say, hey, look, it's a dud. Because I'm not necessarily suggesting that. Markets such as Warwick, look, it's not on our list. It's an absolute regional market.
Okay, so it's 12-month growth,
yep.
24%,
yep.
Still growing at 4.2%, and its average annual growth is 4.8%.
Yeah.
So this is about where to put your money today for the best capital growth, best capital growth in 2024.
Yeah. And this is it, right? Like if you
so it's probably going to and then nothing.
And I'll relate this here right now is that Warwick. Over the last 10 years, the average price in Warwick 10 years ago was about $235,000. The average price of Warwick in 2019 was about $240,000. The The average price of Warwick now, what is it on that report, Phil? I'm assuming it's about 400 odd grand, give or take, somewhere around about there. If I bring it up, you'll give it to me in a second. I guess what I'm trying to highlight here is that if anyone goes and puts Warwick on a map, 370. So what I'm probably getting at is that if you put Warwick on a map and you just Google mapped it right now, you'll see it's in the middle of nowhere. It's a very small market that's got essentially a couple of drivers, mostly be it agricultural. Nothing else is lifestyle, etc., hospital, university, none of that is going to be a driver for employment or demand. Now, if you dial yourself back 10 years and you said, what could I do with $230,000 or $240,000 10 years ago? And I know we've mentioned quite a number of markets that have had very insipid growth, be it predominantly around markets of Perth that have had very average annual growth. But what I'm trying to get at here is that those markets over time are growing. They're growing as far as population. They're growing as far as jobs. And when it comes down to it, we're trying to find markets that are going to have more demand over a prolonged period of time, which is going to influence the price of property as opposed to just a random freak of nature time, which was the COVID-19 and made money cheap and basically everyone chasing and putting money into property for a very short period of time. If you put $250,000 into Western Sydney 10 years ago, it's worth double, probably triple. If you put $250,000 into Western or Northern Brisbane, which would have got your freestanding house 10 years ago, it would have doubled. If you put $250,000 into Western, Southern, Northern Adelaide, again, same thing Melbourne, same thing Hobart, kind of getting close to the same thing in Perth now too. What I'm trying to get to here is that if you put that same amount of money, i.e. for $500,000, or let's say the limit's $400,000 now, and you find a major metropolitan market and you can find a freestanding established house, the chances of that property outperforming a market such as Warwick or any other market that's very similar, just because it fits the budget doesn't mean you should buy it. Just because it has the yield doesn't mean you should buy it, because that doesn't dictate what's going to happen in that market over the next 10 years and beyond. So for me, the best advice for anyone who's in a similar position and thinks, I've got a limit of 400 grand, what can I do? I'm not just going to all of a sudden start with a budget and go to realestate.com and find something not only that fits my budget, but is somewhere close enough for me to drive to. Don't let your own biases get in the way of what a good decision is. Let the fundamentals of what's driven property over the last 75 years, which has dictated growth, let that do essentially the decision work for you, because there's enough markets out there that will still fit that budget that we expect will well and truly outperform a large amount of these much, much smaller one-dimensional regional towns just because they're under that price range.
There would be some people who are big advocates of regional Australia that would probably give a different answer to that. Maybe we can.
And I'm happy to hear that
about that. Yeah,
yep.
But I'm just looking at it. I'm just looking at it. It's middle of nowhere, right? But most places in Australia, if it's not in the capital city, are in the middle of nowhere.
Yeah, but I mean, when I talk about regional, there's a difference between regional and that kind of regional. I guess that's probably the point I'm getting at here, is that regional with 100, 200, 300,000 people who live there permanently and have a multifaceted employment driver, that's a different proposition to somewhere like Warwick. Like Armidale, but like if I'm talking probably more major, like regional, larger regional hubs, and I'm not suggesting we're buying these markets, but like Toowoomba, I said this market's near Toowoomba. Toowoomba's a much more established regional market. Townsville, another one. You know, those markets are established. They have multiple drivers. Yes, they'll still have peaks and troughs, but there's a lot more going there over the long term than I would suggest for a very, very small sort of 1 or 2 pub regional town.
Yeah, it's an hour from Toowoomba.
Yeah, there you go.
On the New England highway. It's on the highway. Okay, I hope that helps. Okay, real quick, we've got to get through this. There's 2 questions, not necessarily. This is 2 questions not necessarily connected to report. This was from Jordan E. The suburb of Luddenham is situated right next to the new WSI International Airport. However, I feel like its residential property is overlooked and still quite cheap compared to lots of Western Sydney. Why? If you had to choose between either paying $20,000 in LMI or B, opening a business overdraft using the money to pay the overdraft to the full 20% and then slowly paying off the credit, what would you do? Okay, 2 questions.
2 questions.
Let's look at the second one first. Not really going to get into that because that's financial advice and you need to make a call on that. If you're paying $20,000 in LMI, that's a big purchase.
That's a big purchase. That's probably that's well north of $1 million.
Yeah.
Yep.
Yeah. So I imagine they're looking to buy a property out near the
London.
Airport. Is what I'm saying. I would say the overdraft rates and the additional money that you spend on the LMI is probably consistent. However, you probably want to be keeping the money in your overdraft and capitalising the LMI into your loan.
Correct.
It's probably what a financial person would say.
That's what I'd be doing.
Because then you get the benefit
Liquidity,
of both of them.
Yeah, and tax deductibility, correct.
Yep. So, but that's not financial advice, but speak to your accountant about that. Luddenham, it feels like as residential property is overlooked. Well, everyone's been buying out there for the last 20 years waiting for an airport to arrive, haven't they?
Yeah.
Prices are off the charts.
40 years.
40 years.
Yeah. It just depends on who you speak to, because the older they are, the more they've said that, it was promised X amount of time ago.
My grandfather bought a place out there waiting for the airport.
Guess what? If your grandfather bought a place anywhere in Sydney 40 years ago, they've done well.
Happy days.
I'll add my 2 cents to Luddenham, because I think there's a lot of markets around sort of the greater west and southwest Sydney which are still acreage for the most part. And we had a chat with this off air about Luddenham in general, but we just sort of looked at its proximity. It's going to be within 5-8 k's of where the airport's going to be. That's fine. You know what? If you look at the data around places like Botany and Mascot over the last 20 or 30 years, it hasn't outperformed the Sydney market. Hot tip. And that Sydney International and Domestic Airport has been there for longer than that. What I'm trying to get at here is that an airport, once it's established, doesn't improve the price of property. An airport that is going to be built and potentially change zoning, which has already happened and happened about the best part of a decade ago. The buybacks, the rezoning, the land, that's already happened. Anyone who's held out and still owns rezoned land that they bought 30, 40 years ago, they've still got a gold mine they're sitting on, and they might be holding out for a different price. But if you're going in there to buy a standard residential freestanding house right now, thinking that property itself as a 600 square metre block, as an example, is going to outperform the general market just because it's 5 k's from a new airport, don't think that that's going to happen. Yeah.
Well, the logic I think that people have is that they go, well, more people are going to want to live there because they're going to want to live close to where they work.
Yeah.
Is really the only logic. And or road infrastructure will be better because, it's going to get people in and out of the airport, and there's going to be a train line to get in and out of it. So, yes, there will be better amenities by way of transport linkages.
Yep.
But people don't want to live under an airport flight path with noisy planes, right?
Typically not. Typically not.
You've got to look at this stuff, right?
And Luddenham's still, it's not close to much. And even when it's close to the airport, it's going to be close to the airport and probably a fair bit of industrial precincts. And there's some upgrades to some pretty big infrastructure things granted there. But we looked at this, it's 20 k's from Penrith, it's 30 k's from Liverpool, it's 30 k's from Campbelltown, it's 60 k's from the city, it's 70 k's from the beach. It's not really close to anything, and it's not going to be that much closer to much when you start to justify. And I've just brought up 12 months worth of capital growth. People might be shocked to hear, and this is where the extremes are for these acreage markets. Luddenham is down 44.7% in the last 12 months.
Wow.
If you look at CoreLogic data, and that's on a transaction volume, so total amount of sales, that works out to be about 25. And
so they've been 25 sales.
25. And that's what it comes down to, is that you can't really.
So everything's already happened.
Everything's already happened. And most of these properties are still large acreages, and the value will differentiate
What's
depending.
the average price in Luddenham? Median, sorry.
It is $1.34 million. Luddenham. But again, what are you looking at? You're looking at an acre? Are you looking at 10 acres? That's essentially going to be your median price.
Yeah, and it could be skewed, right? If someone did an off-the-plan thing and whatever, it'd change those numbers straight away.
And that's why those markets didn't really come and feature in this list as well. Is that you have to have a high level of conviction as to how many transactions are happening that are like-for-like transactions.
Yeah. Okay, a couple more questions. Simon has a party. He's a commercial industrial sales and leasing. So this guy's in the game. Mm-hmm. Simon in real estate. Hi, Philip. Hope you're well. Although I was so happy to see that I hold property in 2 of the suburbs listed in your report, I was also surprised. I don't think I hold property in any of the areas listed in this report.
There you go. I didn't either. Oh, actually, no, I owned in 1 and I've bought in 2 since I've released the report, funnily enough, because I saw the data and I was like, I can't pass this up.
There was some I remember in the 178 that were the initial sort of cohort. Yeah, but there's nothing.
Can't afford to get in there,
can't it? It's bloody expensive.
It's bloody expensive.
It's happy to see I hold 2 property suburbs in this report. I was also quite surprised. One of the suburbs is Raceview. We spoke about that. That's in Ipswich.
Yep, correct.
And has seen massive growth in recent times. I purchased a dual occupancy for $459,000 in August 2021, and as a rough estimate, it's worth around $6 to $630 today.
Yep.
I know a lot of people have done that as well.
Yep.
I was a little surprised to see this suburb on the list, as I wouldn't think there would be substantial growth left to see. Can you please tell me the factors that went into selecting these suburbs? Well, we've gone through all of that.
Correct.
All the reasons why. And race view, let's look at the numbers. What's the most up-to-date numbers there, Paul?
Of race view, I'll bring that up. Give me
I'll
4
tell you.
seconds on my teledex here.
That's RP data, right?
Correct.
Yeah, so these numbers are RP data, but now they've
been updated.
They're updated
this is
because
month on month.
month on month,
So
right?
you're talking median value is up about 2% over the year. If we talk about the last 3 years, right in saying it's probably done 50% growth in the last 3 years.
Yeah, the report says the 12-month growth is 24%.
Yep.
Average annual 5.4%.
Yep.
And quarterly is 3.2%.
Yeah. So quarterly, this is talking about quarterly. It's about right. It's probably pretty close to still tracking about 2 to 3% on quarter.
So
here.
still growing at 12% annually.
Annually.
But that's compounding though.
Correct.
As well, right? 3.2 compounding, not a day.
Yeah. Look, I think it's a valid point for all these markets, and it goes back to the methodology here. So the methodology was talking about which markets are looking more than likely to outperform the national average from a capital growth standpoint for 2024. To that point though, even if you're looking at those numbers as an owner-occupier and investor, a dual key property. I'm not going to advocate necessarily that's a property we'd be buying, but let's assume that property is less than 10 years old, because typically dual keys were something modern invent.
Yeah. They all got built 5-6 years ago.
Exactly.
It's all the rage.
But to build a dual key right now, 3 bed with one side, 1 bed on the other, or 3 and 2, you're not getting change out of $500,000 for any builder, probably more like $550 to $600. So if you're saying, your property's gone from $450 to $600 or $620 or $650 in value, it's still likely to be very much, you're basically owning a property that's worth the block is free. So I guess this is the point here, is that it's still value. And people are going to assess it there, because if someone wants to go build right now a house and land in Ipswich, good luck trying to find change to find a 500 square metre block and build a 4-bed, 2-bath, 2-car garage house for less than probably $650,000. You can't do it because builders can't do it. That's why builders are going bust, because the price of building property has gone up that much.
Yep. Next question from Todd S. He's a project engineer. It's funny, a lot of engineers.
They're very analytical.
Property.
They're the ones who reply to these emails as well, because they do like the facts. They don't want to hear the wishy-washy
mess
stuff.
around with the flim-flam and all that comes out of my mouth.
Yeah.
Hi, Phil.
Filibuster. That's your handle.
Filibuster. Phil the Filibuster Tarrant. Do you reckon I could talk for 5 hours straight?
Oh, no doubt. I have no doubt at all.
Yeah.
Just absolute
Give me a
garbage.
topic, anything. Quick, go.
Recyclable coffee cups.
Oh, God.
Oh, see, I've got you. Put you on the spot. Back to the questions.
I could do that. One thing I did note was that Queensland had a large proportion of suburbs in the Fast 50, whilst also noting New South Wales and Victoria well behind, especially Victoria with only 2 suburbs. So when I first read this, I went, I know how I'm going to answer this, but they pretty much brought it up myself. They brought it up. Would love some insight into why Victoria is so far behind with only 2 suburbs. Possibly the government regulations on land taxes and poor management by dictated down in Victoria. Is it still the COVID hangover for Victoria, and do you see that changing anytime soon?
Mate, it's a tough one, hey? It's we're buying in small parts of Vic at the moment.
But it wouldn't be in Melbourne.
No.
It'd be to the north of Melbourne, no doubt, in big regional areas.
Yeah, a little bit there, and probably a little bit further down towards the Surf Coast and sort of certain pockets of Geelong again as well. And not heaps of it there, but there's a couple of probably under market or under perceived long-term market value markets there. But I think the couple of points raised are quite poignant, because there's some big systemic issues that sit with the Victorian government, and we've only seen as of the last few months that they're throwing Hail Marys from half-court hook shots, which you start to think, well, why on earth would a government be starting to tinker with things like land tax and this change to 2-hectare properties for anyone who holds 2-hectare properties now going to be retrospectively taxed on changes to zoning. This all screams a government that is cactus as far as their cash flow is concerned, and very poor money management. Again, we're not going to get political here, but if you're going to invest in that state, you've got to be somewhat wary of how much of this do I have control of and how much do I not.
Well, remember last year, I got stuck into it, the Queensland government.
Absolutely.
Going, we're going to charge everyone, if you own property in Queensland, we're going to charge you land tax on all properties that you own across Australia.
I distinctly remember sitting down with yourself and your business partner, Phil, and we started to do some math on and we started to think about your land tax bill was going to be going from basically nothing in Queensland to extreme amounts of money because the threshold, and this is anyone, the amount of phone calls I fielded there in a very short period of time, people freaking out, thinking they're about to absolutely lose everything, including the shirt off their back, which was going to be the case, to be fair, if that all got passed.
Look, I don't want to get political on this, but
Blacktown City Council.
Sort of knocking around government a bit, like local, state, and federal, right?
Yep.
I saw some report. I was in the Qantas lounge waiting to go down there, and I saw this thing flash on. Where the flights come up, there's always like stories and stuff there on whatever, and it said
first class lounge.
Of course, pretty much saying. The public service voted as the best place to work was the headline. It pretty much said some survey. Yep. There's always 1,000 surveys that pretty much said the best place to work is the public service. And I sat there and I went, oh yeah, okay, fair enough. And the reasons why is job security and benefits, and you don't have to work too hard and all that sort of stuff, right? There's a level of protection working in the public service. Once you're in, it's hard to get out, and you got to. Public service is everything from government bureaucrats to cops or nurses, teachers, right? That's putting nurses and cops and teachers aside, talking about the bureaucrats, and sort of navigating just government in general and bureaucracy. You sit there and just go, the people that work in government, they've got a tough job and it's an important job and stuff, but there is so much wastage. There is so much wastage. There's a lot of people getting paid to do stuff that doesn't add a lot of value, right? So when you sit there and governments come out, like you just imagine the meeting with the Premier of Queensland going, someone goes, I've got a good idea. Why don't we just tax all property investors, all of their properties right across Australia, and then we can get all the money? Right? Do you really think that person was a property investor? Do you really think that person has any experience outside of the government? But this is the risk you take.
This is the hilarity. But then the justification for it at the time was that, well, there's not enough supply for owner-occupiers in the market. They wanted to stop investors. Yeah. And now essentially there's a whole bunch of data. I actually did a podcast with a large quantity surveyor only a couple of weeks ago, and basically they contributed to a realestate.com article because they've got a whole bunch of data on depreciation schedules and how many were ordered and some perceptions there. But now the impact of what that meant is that there's a whole bunch of people who pulled out their investments, sold them to owner-occupiers in Brisbane, Gold Coast, etc. They're in a rental crisis. They have astronomical growth in rental values, sub 1% supply because investors sold. And now, lo and behold, they've still got population growth, but they don't have rental supply. No one's building property, so they've got this issue. The irony of this, Phil, and going on this rant, is that who gave them the tap on the shoulder from a treasury standpoint? They just posted a $10 billion surplus as well. So they're saying, oh, but we need the money. This is to add money to the coffers. But then someone's coming out that literally less than a year after saying, we just posted a $10 billion surplus, predominantly from mining royalties. Yeah. And all of a sudden they're saying, oh, we're crying foul because we're going broke.
This is why the government in the last budget is like, we're in surplus. Yeah, it's because Australian employees are employing a lot more people who aren't sucking on the teat of the government dollars with unemployment benefits or otherwise. They're working, and if people are working, guess what? Tax receipts go up. Whee! Yeah. Give the money back to the SMEs of the world. Stop taxing property investors.
Payroll tax.
Payroll tax. But this is it. Like these people making the rules. This is if you want to play in property. If you want to play in property investment, 90+% of all investment properties or rental properties in Australia are owned by owned by mum and dad investors, right? That number changes thereabouts all the time. But it's a lot. It's a lot. Most rental properties, mum and dad investors. So if you want to get into it, you've got to put yourself in the hands of sometimes inept government bureaucrats who think they'll have a great idea and you can't control it.
But be vocal. I mean, the other thing I hear with this too, mate, is
Blacktown Council.
You mentioned that there's whispers around the halls of Parliament at the moment talking about potentially Labor coming back with neg gearing, abolition, etc. Which whether that's going to be rearing its head or not. But I think the 2 million odd property investors who are private property investors in Australia and the 250 odd thousand who listen to this podcast. It's all of our really, it's our mandate, it's our goal. It should be our mission that if we're around that sort of barbecue talk, to spread the facts. Don't spread the scaremongering mentality. To say the fact of the matter is that the ones who are investing in property are providing accommodation for private investors, for private renters rather, and it doesn't get the accolades it deserves. And I'm not here to say that people deserve medals because they're just trying to better our financial future. But the facts are that if we take them out of the equation or disincentivise them, we're going to have far bigger issues to deal with here, far, far bigger than what we've currently got.
And this is the art of property investing, and I'll sort of leave the questions there, but I'll summarise like this. The art of property investing is understanding the difference between, as part of your process of working out what you're going to do, there's disinformation and there's misinformation, two very, very different things. The disinformation is deliberate information which is false to try and shape or persuade people to do certain things or take action in a particular way. Misinformation is people sharing incorrect information unknowingly or sometimes knowingly, right? So misinformation, disinformation, certain political parties will present certain facts on the basis that they probably believe they're correct, but they're probably not correct, and people make decisions on it. Whereas misinformation is when a taxi driver goes, "Oh, did you hear that Bellbird Park is a really good place to invest?" Right? Might be, might not be. But they're sort of just going, yeah, look, I'm sharing this information because he thinks it's right or she thinks it's right, but it's not right. So you find that a lot of property investors invest on those types of things, you know.
Agreed.
And they're big investments.
They are. Typically, they're only making one, maybe two, and that's the reason why they're only making one or two.
But they'll spend hours and hours and hours and hours and hours and hours working out whether or not the Fisher & Paykel 427X is better than a Samsung whatever, right?
Completely.
It's crazy. Crazy for a $600 washing machine or whatever it is, you know.
And they won't seek professional advice majority of the time either, nor will they seek a third party who's got nothing to do with the actual decision itself.
They'll spend 10 hours trying to book a flight.
Yeah.
You know?
Yeah. And wait for a certain sale to come around, like, mate. Yeah.
Then spend 14 hours in Beijing waiting for the next flight.
For 6 flights to be cancelled, only to realise that it's a one-way ticket anyway.
Oh, God. Locked up in Wuhan. COVID-19.
Unbelievable.
Anyway, we'll leave it there. That's an hour 25. It's a marathon podcast. 2 for the price of 1. Look at that.
Heavy.
We did it. All right.
Good.
So there's a lot more questions. We might get around to them. We'll just keep aggregating them. I might answer them on another podcast in time. But thanks everyone for writing. If we didn't get to your question, I'm sorry. Look, we gave this good old crack. But really appreciative of everyone that wrote in, and the team will write up stories on all of these things as well. So if we didn't answer, stay tuned. We'll try and get to it as quickly as possible. Now, Paul, you've stuck it there so I don't avoid it, and I haven't spoken about it yet, but you put a book in front of me. I imagine you want me to talk about it.
Well, that is the old book. Not the old book. It's still a
new old book, is it?
It's an old new book. It's a Surfer's Guide to Property Investing. Anyone who hasn't downloaded it, go to my website, purepropertyinvestment.com. You can literally download a copy for free. Just pay for the postage. I'll get it in the mail.
Yeah.
That's not the point. The point is, we've just signed with our publisher to renown and essentially release in the next probably somewhere between 3 and 5 months, version 2.
How much rewriting does it need? Because that sucks.
That's a big job. It's an awful job, and I'm probably going to narrate the whole thing too. And I've been told that's going to be.
Are you going to narrate it?
It's going to be a hardcore job, that one. But what we're really doing is we're adding a couple of different chapters in here, including data from COVID, including data from the GFC, including data from a couple other major downturns that have happened, and what happens in the following 5 and 10 years preceding that major downturn. So I think for anyone who's sort of bought property or think about property, or who bought property prior to COVID and thinking what happens next, it's happened before. These types of impacts happen before. I'm going to write all about that, but also add more context as to how do you exit from bigger portfolios? How do you build a big portfolio, exit from it in a way of pay down, sell down, develop, etc., to actually live your best life through property investing? That's the catch line. That's not going to change, because that was the intention here, is to say, how do you invest in property to actually better your life?
Well, the question I have, Paul, is are you going to get this soft focus cover photo? Are you actually going to be on a wave next time?
Pretty sure I got a whole bunch of action photos taken when I got that one. And that one was just the one that made the front page.
Is it? No,
yeah, there's a few others in there. Look, mate, first page, I'm pretty sure it's somewhere there. Me paddling. Oh, no, it's not. It's the same photo, unfortunately.
The same photo. Anyway.
Anyway.
I want to see you Shark Island,
pig dogging,
15 foot.
That's not going to be me, unfortunately.
Sucking.
We joked about it, but it's probably more the Kook's Surfer's Guide to Property Investing. And
it's a surfing term.
It's an analogy at best.
Yes. No, all right. Well, thanks for coming on, mate. I really enjoyed the
I appreciate
discussion.
it, mate.
It was good. Paul Glossop is the CEO over at Pure Property, who partnered us on the Fast 50 report. Where to put your money today for the best capital growth in 2024. If you haven't yet downloaded it, it's still available. Smartpropertyinvestment.com.au. You can go and download it, and it's all there. It's free. Go and check it out. You're crazy if you don't. Thousands of people have already checked it out, which is pretty cool. It's nice to see that people are taking the advantage of a lot of work that goes into reports like this to help shape their investing decision. Thanks again to the team. They've been very patient with us as we put together this report and also record all these podcasts. Big favour for me if you can leave them a review wherever you're tuning into this, mostly on Apple. They get a real kick out of it to show that we're doing the right stuff. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.